The last time this many warning signals lined up at the same time, it was 2007. Nobody listened then either. Right now, 6 of the most reliable recession indicators in American economic history are flashing simultaneously. Consumer debt just hit $1.28 trillion on credit cards alone. Total household debt crossed $18 trillion. The largest oil supply disruption ever recorded is pushing gas past $4 a gallon for the first time since 2022. And the U.S. economy just lost 92,000 jobs in a single month, a number Wall Street did not see coming. Here is what makes this different from the usual recession chatter. This is not one problem. This is not one sector under pressure. This is a convergence. Consumer stress, commercial real estate defaults, an energy shock from an active war zone, and a labor market that quietly turned negative, all happening in the same quarter. That combination has not occurred since the 12 months before the 2008 financial crisis. The pattern is not forming, the pattern is here. And most people are looking at the stock market instead of the data underneath it. What happens next is the real story. To understand why this moment is structurally dangerous, you need to see how fast the floor shifted. 12 months ago, the consensus was a soft landing. Inflation was cooling. The Fed cut rates 3 times in late 2025. Bringing the target range down to 3.5% to 3.75%. GDP growth looked stable. The word recession had almost disappeared from financial headlines. That was the surface. Underneath it, the cracks were already forming. Job growth had been quietly revised downward, nearly 911,000 fewer jobs than originally reported for 2025. Monthly employment gains collapsed to an average of just 17,000 since April. That number would have triggered alarm bells in any normal cycle. But reduced immigration masked the weakness because the economy needed fewer new jobs to hold the unemployment rate steady. The labor market was not strong. It was shrinking in a way that made weakness invisible on paper. Then February 2026 hit. The economy did not just slow down, it reversed. Negative 92,000 jobs, the 5th month of negative job growth in the last 9. At the same time, the Iran conflict erupted. Oil surged past $100 a barrel. The Strait of Hormuz, the passage for 20% of the world's crude supply, shut down. Gas prices jumped $1 in 4 weeks. 2 shocks, one external, one domestic, both arriving at the exact moment American households were already stretched to their financial limit. But the job losses in the oil shock are only half of the equation. The part most people are not watching is where the real risk is building. Here's the breakdown of what is actually happening across 3 pressure points simultaneously. The first is the consumer. American households are carrying $1.28 trillion in credit card debt. It's the highest balance ever recorded by the Federal Reserve Bank of New York. That number has climbed 66% since early 2021. The average credit card interest rate sits at nearly 21%. More than half of all cardholders are now carrying balances just to cover essential expenses. It's groceries, utilities, gas, not luxury spending, survival spending. Delinquency rates across all household debt categories just hit 4.8%, the highest level since 2017. Among lower-income borrowers, the deterioration is accelerating. The second pressure point is commercial real estate. Office loan delinquencies in the CMBS market surged to a record 12.34% in January 2026. National office vacancy rates sit above 20% in major markets. Nearly $5 trillion in total commercial real estate debt exists nationwide, and more than $100 billion in securitized mortgages mature this year. Less than half are expected to pay off at maturity. The first bank failure of 2026 already happened. Metropolitan Capital Bank in Illinois, seized by regulators with $261 million in assets and direct ties to real estate exposure. But this is where the story changes. In 2008, the trigger was residential real estate collapsing into the banking system. In 2026, the commercial side is following the same transmission path, losses concentrating in regional banks that hold 44% of their balance sheets in commercial real estate. The same banks that provide credit to small and mid-sized businesses across the country. The dominoes are not identical to 2008, but they are arranged in the same sequence. And the third pressure point, the one accelerating everything, has not even fully arrived yet. The third pressure point is energy, and it is the one that turns a slow deterioration into an acute crisis. The U.S.-Israeli war on Iran triggered the closure of the Strait of Hormuz in early March 2026. The International Energy Agency has called it the largest supply disruption in the history of the global oil market. 20% of the world's crude oil supply was taken offline almost overnight. Brent crude surged past $120 a barrel at its peak. Even after a fragile ceasefire was announced in early April, oil remains near $100, roughly 40% above pre-war levels. Gas at the pump crossed $4 nationally for the first time in 4 years. In California, drivers are paying $5.89 a gallon. Diesel, the fuel that moves every product in the American supply chain, jumped over 50% year over year in most states. Here is what that means structurally. Every previous oil shock of this magnitude has produced the same downstream sequence. Transportation costs rise within days. Grocery prices follow within 2 weeks. Manufacturing input costs adjust within 30 days. And consumer spending contracts within 60 days as households redirect income toward fuel and food. That is not a theory. That is the documented supply chain timeline from 1973, from 1979, and from 2022. What makes 2026 different is the starting position. In 1973 and 2008, the oil shock hit an economy that was overheated but still structurally functional. This time, it is hitting an economy where consumers are already maxed out on debt, jobs are already contracting, and regional banks are already absorbing commercial real estate losses. The shock is not creating the weakness, it is accelerating a collapse that was already in motion. And the strategic calculation behind the Hormuz closure reveals something most coverage is missing entirely. The Strait of Hormuz was not closed by accident. It was closed by design. Iran's strategy is not military. It is economic. The logic is straightforward. Raise the global cost of the war until the pressure for de-escalation becomes politically unavoidable in Washington. Iran cannot match U.S. firepower. Every military planner in Tehran understands that. What Iran can do is weaponize geography. By shutting down the choke point through which 20 million barrels per day of crude normally flow, Iran turned every gas station in America into a pressure gauge on the White House. Every dollar added to the price of a gallon is a unit of domestic political cost for the administration heading into midterm elections. The calculation is precise. Voters do not track missile strikes, they track fuel receipts. The Federal Reserve is now caught in the worst possible position. Inflation was already sticky at 3% before the oil shock. Energy-driven price increases will push that number higher through the second and third quarters. Under normal conditions, the Fed would raise rates to contain inflation. But raising rates now would crush an already weakening labor market and accelerate the commercial real estate debt spiral. Cutting rates would ease financial pressure on borrowers, but risk embedding a new inflation cycle. The Fed has no clean option. Every move damages something. This is the structural trap that institutional investors are already positioning around. Capital is rotating out of rate-sensitive assets and into hard commodities, short-duration treasuries, and defensive equity sectors. Gold is absorbing inflows at levels consistent with every previous U.S. banking stress event. The smart money is not waiting for official recession data. It is reading the same convergence and acting now, weeks or months before the headlines catch up. The question is not whether the pressure builds. The question is, which component breaks first? The consumer, the banks, or the labor market? And that answer depends on how long the energy shock persists. But the other side tells a different story. The counter-argument is serious, and it deserves a fair hearing. The optimistic case rests on 3 pillars. First, the banking system is better capitalized than it was in 2008. Tier 1 capital ratios at major institutions are significantly higher than pre-crisis levels. The stress testing framework that did not exist before 2008 now runs annually, and the most recent scenarios already model a 40% decline in commercial real estate prices. Second, the AI investment boom is injecting real capital into the economy. Business investment is projected to grow 4% in 2026, driven by hyperscaler spending on data centers and infrastructure. Third, the ceasefire with Iran, however fragile, suggests a possible path toward reopening the strait and normalizing energy markets. If oil falls back toward $70, the entire inflation pressure reverses within a quarter. There is also the rolling recession theory. The argument is that the U.S. economy does not collapse all at once anymore. Individual sectors take turns contracting while others expand. Tech crashed in 2022 while manufacturing boomed. Manufacturing contracted in 2024 while semiconductors surged. Energy is booming now while retail weakens. The economy absorbs sectoral damage without triggering a full systemic event. Here is the precise gap in that argument. The rolling recession theory works when the consumer is strong enough to bridge the gaps between sectoral downturns. In 2023, that bridge held. In 2024, it bent. In 2026, the bridge itself is cracking. Consumer confidence has declined for 3 consecutive quarters. Fear of job loss is at the highest level recorded in over 2 decades of measurement. Credit card debt is at an all-time high, while real wages remain flat. The consumer is not bridging anything. The consumer is the next sector in the rotation, and there is nothing underneath to catch it. That is the difference between 2023 and now. And it is the difference most models are failing to price. Here's where this stops being a macro story and starts hitting your household directly. Gas prices. The national average is $4.12 a gallon as of this week. That is a 46% increase from the same week last year. If you drive 25 miles per gallon and commute 40 miles round trip to work, your monthly fuel cost just increased by roughly $90. For a 2-car household, that is $180 a month that did not exist in your budget 60 days ago. In states like California, Arizona, and Florida, the damage is significantly worse. Diesel, which powers every truck delivering every product to every store, is averaging $5.43 nationally, up over 50% year over year. That cost does not stay in the trucking industry. It passes through to the price of everything on the shelf. Groceries are next. The supply chain timeline is predictable. When oil sustains above $100 a barrel for more than 3 weeks, food prices begin adjusting within 14 days. Dairy, meat, and produce, anything that requires refrigerated transport, moves first. Brazil, which supplies nearly 60% of the world's soybeans, depends on fertilizer that transits the Strait of Hormuz. A sustained fertilizer shortage pushes crop yields down and grain prices up on a global scale. That reaches American grocery aisles within 1 to 2 quarters. Borrowing costs remain punishing. The Fed is frozen. No rate cuts are expected in the near term, which means mortgage rates stay elevated, auto loans stay expensive, and credit card APRs hold near 21%. If you are carrying a $6,500 credit card balance, the current national average, you are paying roughly $1,365 a year in interest alone. That number does not shrink until the Fed moves, and the Fed cannot move until inflation breaks. And inflation cannot break while oil stays above $100. That is the trap. Higher energy drives higher prices. Higher prices freeze the Fed. A frozen Fed keeps borrowing costs elevated. Elevated borrowing costs squeeze the consumer further. The loop feeds itself, and right now, nothing in the policy pipeline is positioned to break it. Here is what happens next. 2 scenarios. Both are realistic. The data supports each one depending on a single variable, how long the energy shock persists. Scenario 1. De-escalation path. The U.S.-Iran ceasefire holds through the Islamabad negotiations. The Strait of Hormuz reopens to commercial traffic within 2 to 3 weeks. Oil drops back toward $85 by late May. Gas prices stabilize near $3.50 by midsummer. In this scenario, the inflation spike is temporary, and the Fed gains room to cut rates by September. Consumer pressure eases modestly. Commercial real estate losses continue but remain contained to the office sector and a handful of regional banks. The economy slows but avoids a technical recession. GDP growth lands near 1.5% for the year. This is the soft landing, bruised but intact. Scenario 2, escalation path. The ceasefire collapses. Israeli strikes on Lebanon already violated the framework within 48 hours. Iran reclosed the strait in response this week before partially reopening again. If the conflict reignites fully, oil executives and energy analysts have warned that crude could reach $150 or higher. Gas prices would push toward the 2022 record of $5 a gallon nationally. At that level, consumer spending contracts sharply. Retail and hospitality layoffs accelerate. Regional banks absorbing commercial real estate losses simultaneously face declining deposit bases as households draw down savings. The Fed is forced to choose between fighting inflation and preventing a credit contraction. Historically, when forced into that choice, the Fed has always chosen to fight inflation first and accepted the recession that follows. The probability split right now sits near 55-45 in favor of de-escalation based on the diplomatic trajectory. But that number shifts daily, and the structural damage underneath lead the consumer debt, the commercial real estate defaults, the job market deterioration. Lead does not reverse even in the optimistic scenario. It only stops accelerating. The pattern from 2007 is worth remembering. The warning signs appeared in the spring. The political conversation did not catch up until the fall. By the time the average American understood what was happening, the window to prepare had already closed. That window is open right now. It will not stay open long. If this breakdown gave you clarity, subscribe, because the next 90 days will determine whether this comparison to 2008 stays a warning or becomes a headline.